Hello and welcome to the Trading Zone presented by the MyX on the Tradier Hub every Monday, 1 o'clock Eastern Time. Thank you all for tuning in. I'm going to give everybody just a few more minutes to join in. Maybe we'll have another guest here joining us in a minute if you hang with us. So just really excited. Last week was a fantastic week. Really fun action in the market. We had the Fed jumping in there with their big results. And yeah, just super fun week last week. Thank you. Thanks everybody for joining in. Comments coming in already. Remember, make sure to just say hi right now. It's just me and you. Help me out a lot if you just say hi and hi, AK. It's going to be a great show. Yeah, the Fed announcement was a lot of fun last week. You know, it was expected to be a surprise, being that people weren't really sure. Is it 50 basis points? Is it 25 basis points? I don't think it was a surprise. It turned out being 50. For me, it was a surprise that it turned out to be a dovish 50. The Fed gave dovish commentary and the bigger rate cut. I think that was a little unexpected. So that is not really a huge surprise, but you know, I will classify that as a surprise. Just again, everyone, thanks for joining me today. Hope everybody had a great week and hope everybody had fun trading the Fed last week. This is the Trading Zone. I'm Joe Teague from Equity Armor Investments. I'm a portfolio manager of the Rational Equity Armor Fund, the Catalyst Hedged Equity Fund. I'm also former VIX options market maker. Wealth of knowledge when it comes to volatility trading, and certainly a specialty when it comes to volatility futures trading. So really excited to share that knowledge with you all today. Thanks again for everybody joining. I think I'm ready to pop off. I think I'm ready to go. Does anybody have anything they want to say? Let's see. For me, it was a great weekend. I saw my Lions win. My Spartans could not pull it out. Fun. They're a fun team to watch, so at least I got that going for me. At least they're not as bad as they've been lately. It's fun to see the Bears. Tough game for them, but yeah, I am just living the dream as usual. This is the Trading Zone. Let's. I think we're pretty good. We're 3 minutes into the show. We've got some people here. Thanks everybody again for joining us. Let's get in there. Let's get into it. So on Friday, we saw some big action. I thought this was really interesting, seeing Intel getting a potential offer out there, white knight maybe, coming from Oracle. But now they're getting more investment opportunities here. We got the Apollo Global saying, hey, they want a piece of that. So for me, this is very interesting. I'm going to trade Intel at the end of the show. Make sure you stick around to see what I have to think about that. But yeah, I think it's very interesting. Remember, Intel down 50% on the year when you have a lot of the chip makers having tremendous years. So they're just not partaking in this AI rally. There's a lot of people that think, hey, if maybe Intel does things a little bit differently, a new management group perhaps could do it, because they're getting a ton of money from the government. They have a plant coming up in Cleveland, or not Cleveland, not Cincinnati, Columbus, the other Ohio city, a huge foundry coming up. Billions and billions of dollars being spent to build this thing. My in-laws are from Columbus, and boy, they just talk about truck after truck after truck of concrete coming in to pour this new foundry. So just a tremendous investment going on. So Intel's got a lot going behind it. Are they going to be able to finally put it together and turn this company around? Couple recent offerings up there. Interesting to see. Again, I'm going to be trading this at the end of the show, and maybe I'll get Brian's thoughts about it too, if we can get him in here. Oh, hello there, Mr. Stutland. How's it going?
Hey, happy Monday.
Happy Monday. We're just jumping off here. Really excited to be here for everyone to talk about the markets. Just bringing up Intel, Brian. I'm going to trade Intel at the end of the show in case you want to get your own thoughts about how you would trade this too ahead of that. But everyone watching can also think about how they would do it also. But I'll let you know what I'm thinking about if you stick around to the very end of the show.
Yeah, I'm glad we're doing that because we just added full disclosure intel to client portfolios this last week on some of this action, and so I think we're excited about what they might have in store finally for a stock that's gotten just killed over the last couple of years and really fallen behind the chip race.
Yeah, I mean, I know of a lot of proxy battles in my career trading, and usually I think, oh, this is just some rich guy trying to make some money or whatever. But in this case, I really do think there's a great point to be made. This board has not done this company right, so they needed to shake some things up. Before the Oracle bid, they had a new announcement they were going to turn their foundry into a subsidiary. I think that was a really smart move. Something finally getting on the right foot, but they just got to improve their products. They need to catch up to NVIDIA. They need to have these faster chips to be able to partake in this AI battle. Anyways, should be interesting to see it play out. Last week, of course, it was all Fed all the time. Not a lot going on this week, given what happened last week. I think we need to kind of digest the Fed still, Brian. The Fed had really interesting commentary. There's more Fed commentary even today. Like the surprise I mentioned before you hopped on, Brian, the surprise for me wasn't that it was 50 versus 20. The surprise was that it was a 50 and dovish commentary. I think everyone thought if it happened to be 50, it'd be hawkish commentary. No, we got the bigger cut and we got dovish commentary, more dovish commentary coming out with Goolsby this morning. So the Fed seems intent on getting the message out that they are cutting rates, and they're cutting rates quickly.
Yeah, I mean, look, we laid out the playbook last week, Joe, and I mean, both of us said that no matter what was going to happen, they were going to have dovish kind of commentary, right? And the playbook was that if they were going to cut 50 basis points, that the market could rally because that was going to be anticipated as lots of liquidity. And it wasn't just like you said, the 50 basis points. There was dovish commentary, but if you also looked at sort of the Fed dot plot, which the Fed likes to produce, every quarter or so, where they give basically each of the Fed governors predictions of where they think interest rates would be in the future. We did start to see that come even lower than expected from the last SEP that they released before. And so when you got that, not only did we get 50, we got dovish commentary, but they actually showed the dovish commentary, visibly. And then, like you mentioned, Goolsby this morning, talking that we're going to cut, as much as we can, that unemployment, they're basically turning over the picture to say unemployment's more of a risk now than inflation was before. Clearly they're comfortable with, the one-time 20% inflation hike that we saw over the last couple of years. And they're like, fine, we're never going to get that back. We'll take the one-time hike and then try and keep it at 2% going forward from then on. That's the wrong move, but that's something that they'll live with, the rest of the world will live with. And, Chipotle burritos will just be $20 for a burrito,
Well, stick around, Brian, to the end of the show. I got more on that inflation after we get through our main story about volatility being back and here to stay. Finally this week, it's all in the election right now, focusing big on that. They're going to be surprises. We're in October. October is usually a very volatile month of the year, Brian. You know that, but it's also a very positive month after a medium to negative September. So we'll see if that plays out. And now, of course, there's a lot more geopolitical concerns out there in the world. A lot of tensions rising. Oil hasn't really done much, Brian. So as long as that stays in check, I think everything will be okay. But, anything can happen at any point in time. So another reason to be on our toes. Now, this is what we're talking about last week here. Of course, volatility happens to rise. The market tends to go lower when the Fed cuts rates. But I don't know if this necessarily has to happen, Brian. This is when the more likely to happen if we do get a recession. So again, this is going to come back to me, back to the data for me. Are we in a recession? Yeah, then we're probably going to see this type of market activity. If we're not in a recession, then not. Real quickly back into the skew. This is what we look at when we're looking at volatility. It's kind of a leading indicator for the VIX for us. Measures the 25 delta put versus the 25 delta call in the S&P 500. We're on the lower end of our range right here, Brian. So we're kind of settling in, like I suggested, might be a possibility above this level. Actually, if you kind of zoom out to like the 5-year, we kind of had this big run up here, just like that here. We had this big run up here, just like that. And then, we kind of settled into this new range here, volatility, which was higher. I'm kind of expecting to see us settle in at a higher level here, just for the foreseeable future.
Yeah, and I think that's actually giving an opportunity to either buy puts for people as protection, or to buy volatility or VIX futures. Because I think, obviously we trade VIX futures and S&P options for a couple clients, specifically acting as portfolio managers on a couple mutual funds. And so we look at this skew, and to me it says puts are probably cheap enough to kind of own, or some sort of long volatility hedges cheap enough now where we've come off those levels and there's some risk to get back into that higher range of that 5-to-1 ratio of puts to call volatility, where puts go up very, very quickly.
Yeah, and another way to think about that, like we do, of course, is instead of owning the stock, you're owning a call. You're expressing your long position versus via owning a call. That means we know what our downside risk is. We know how much we can lose. And that is typically not the best trade when the market's going higher slowly. But it's a much better trade when the market has, big up days, big down days. So you're risk defined. You might have a quarter down 5%. You might have a quarter up 20% in this type of a move. I think that's what we'd be looking for in the type of strategy.
Yeah. I think what's most interesting too, if we turn to the VIX futures curve, I don't know if you have a chart on that, Joe.
I do. I wanted to show you the change week over week, but go ahead.
Yeah. No, let's take a look at that, because I think it's interesting when you look at what the October future in the VIX is doing.
So this was what it looked like last week.
Yeah.
And of course, that was before the expiration. But here we have this week.
Yeah. So
this was this morning, just an hour ago.
The steepness between the VIX index and the front month VIX future, the October future, which October future settles into S&P options, and these S&P options are looking at November options, which is just past the election. So I get it. Volatility, is a little bit higher back there, but yeah, that steepness, Joe, is tremendous. I don't know. What do you make of that steepness and then flat after?
Yeah, well, they're definitely expecting volatility to rise into the election, and honestly, that intuitively makes sense to me. That works for me. Here's volatility now. Here's where they think volatility will be around the election, and then after the election, again, they're expecting volatility to come lower. So all that checks out to me, but you just have to be aware of it.
Is there any way that you would play this, or just this is how it should shape up, and this is just giving an indication of more of expectations of volatility in the stock market that might occur as we get closer and closer to the election?
Well, yeah. So it makes it very tricky to think, okay, volatility is going to go higher into the election. Let's just own the October future. Well, if you own it already, Bob's your uncle, great. If you don't owning it today, there's some risk here, of course, because volatility is much lower. There's no guarantee that volatility is going to be higher into this spot. For me, these futures happen to be a little lower, but they're still going to be on your sheets through the election if you hold them. So, it makes it for an interesting case. I think just situationally, it might make sense if you see these futures come down on a strong week. Maybe that's time to own it, but it seems really tricky. It seems better to be playing it with S&P options right here.
Yeah, I tend to probably agree with you on that one.
Let's move forward into my favorite chart that we've been looking at every week. Here is the trends in the S&P 500. This is about 2.5 years now. Looking at this trend, we have this accelerating trend line right here in green. This was a great trend line. This is very bullish, this red one, and then boom, it popped off and went into this accelerated channel. We lost that channel. in August, and have had like a nice like recovery getting back up into it. I think it'd be amazing if we get back into it. It's seems a little tricky to get that like final push up there, Brian.
Yeah, I mean, I think obviously we kind of refer to this consistently on how this S&P trend occurred over the last year and a half or so, maybe more. I do feel like that we almost can start fresh and almost erase these trend channels and look at just look at the second half of the year right now. We kind of had this like, topping formation. It looked like the market was going to top out, but then made right there, a higher low, and now breaking through the all-time highs. So to me,
That's
this
absolutely great. Yeah.
yeah, to me, that looks fantastic. It actually reminds me a lot of 1998. We made a lot of comparisons of the 90s versus now, and whether we're really there. If the economic data starts to hold true, I think over the next couple months, the technicals certainly line up like this was just a pause and carpet shakeout on a meteoric rise to the top, where the S&P trades over 6,000 by the end of the year.
Yeah, well, speaking of that shakeout, we talked about Intel not participating in this S&P or the semiconductor rally, but this semiconductor rally was just on fire, was just leading everything. That's not the case right now. We got the market making new all-time highs up here. The semiconductors kind of stuck in this range here, little indeterminate here. Like we haven't made a new high and haven't made a new low. For me, I really, really want to see this taken out here. I really want to see this 150 level regain and have this, looking like a more bullish pattern.
Yeah, I agree. That's probably the one area of the markets that maybe lagged. And then, another area really kind of is like the Mag 7 names have kind of lagged as well. The S&P 100 really outperforming the rest of the broader market here. And you've got names like Walmart and Costco and some of these household, maybe it shows that the consumer is actually kind of strong, and maybe we don't need the semis to lead the way and people just grabbing for growth. And maybe it will be a stronger, more broad-based rally that occurs. But this is the one indicator that worries me a little bit about the market.
Well, these tech companies, a lot of the Mag 7 companies that you're talking about, enormous companies, very little debt, cash kings. They weren't really affected by the higher interest rates. Maybe it makes sense, interest rates coming down. Some of the smaller companies without as much cash, it's going to be benefiting them more than it benefits the big boys. I still think, though, we're early on in this AI craze. People cannot possibly buy enough chips. They can't make enough chips. It makes sense that this will take, if the economy is going to be chugging along, if we're going to have this soft landing, which the market looks like it's predicting, this has to make a higher high here for me.
Yeah, I would probably agree with you. Let's watch this 150 level here on the SMH and see if it can get back above and maybe be an indicator that it can go significantly higher.
Okay, so let's get to our main story. Volatility is back. It's here to stay. Why is it back? Why is it here to stay? So this is what we've been talking about for a while. There's a couple of times in history which look like today. History doesn't repeat itself. It does rhyme. Here are two times where history looks like it rhymes with right now. After September, we had Jackson Hole. The Fed comes and cuts. Now, one time they did this was in 98. Another time they did this was in 2007. In 98, we had the .com boom going on. Right now, we have the AI boom going on. 2007, we had the unemployment situation worsening. Same thing right now. Again, here's 2007. Here's 98. The charts are obviously very different. What's it going to be? Our conclusion is kind of a punt, Brian. For me, maybe you have slightly different, is that we'll know when the data comes out. If it's a soft landing, it's going to look like this. If the jobs get worse, it's going to look like this. That's kind of
what should I do as an investor if I've got Two
Okay,
choices like that.
but what do we know? What can we infer? Well, what is happening when the Fed cuts, whether or not there's a recession, is the yield curve is steepening. Okay, so the yield curve is getting steeper. So we're at this part of the cycle, regardless of what happens in the jobs. There's more economic uncertainty. The yield curve is steepening. Volatility goes higher when that happens. So maybe the soft landing will happen. Maybe it won't. I'm pretty confident volatility is going to be here in either situation. So we talked about earlier, we like owning protective puts. We like owning calls, expressing our long option or our long equity exposure because we think volatility is here for the foreseeable future. And if this is kind of tricky to look at, Brian, I have another visual for you. And I'll break this down. So I got a lot of charts here. Bear with me. I'll go through them pretty quickly.
All right. I like charts. I like charts.
So it's the same chart, but I'll just break through these situations. So early 90s, you had the recession, the economy recovered, and then it started, and then the yield curve, of course, came lower, right? Because gearing up for the Fed to start lowering interest rates again. When the yield curve is falling, not now, when the yield curve is falling, you have volatility low. Okay, it doesn't really make sense to put this in here, but here's 98. That's a big spot for us, of course, Brian. Of course, the yield curve steepened really quickly, volatility steepened really quickly. You snap forward though to the 2001 yield curve steepening. Volatility is now higher. Look, we're going up on here, right? Volatility is higher, yield curve steepening, right? Not going to be a surprise. Volatility or yield curve going flatter. Volatility is lower. So we're going in this cycle. You can kind of see it again. Won't be a big surprise, of course. 2007. After 2007, when the yield curve was flat, it steepened again in 2009. And of course, we saw really high volatility here throughout 2008 and 2009. We all know and remember that very well. So that's just what we have to look forward to, regardless of what's going to happen in the economy. This yield curve is steepening right now, Brian. And I expect we're going to see this squiggly orange line to do that.
I mean, it is really fascinating, the correlation between the steepness of the interest rate yield curve. So when Joe talks about steepening, what it means is that the near-term interest rates become lower than long-term interest rates, like 10 years and 30 years. And when it flattens and goes down, the black area goes down. That means that near-term interest rates are equal or greater than long-term rates. And everybody in the past has said, well, once the yield curve inverts, there's a recession. Well, this is more of a map of what's volatility going to do versus interest rates. And it's interesting that volatility in the S&P 500, which are equity names, are tied to what the interest rate market is doing in itself. And the high correlation between the two. Yeah, I think whether it's 98 or 2007, I guess I kind of pose that question maybe to myself. The answer here that I believe is volatility is higher no matter what. So the market, although it doesn't normally go up and volatility goes up, that can happen. And it did happen throughout the 90s. The VIX actually rose as the market went to all-time highs. And in 2007, the market, as it fell quickly and volatility rose. So either way, I want to be a long volatility trader right now. I know it's kind of talking up maybe our own book as portfolio managers because that's what we do for people, but I think it's the right play right now.
So, we brought this up very briefly, though, Brian. We talked about it at the top of the show. One possible difference, wrinkle between the 2 years and today is the deficit spending that the government is spending. So I just want to bring up this chart real quickly, and hopefully this doesn't make anybody super depressed or sad. But look at this deficit spending, which we have going on right now. So, it seemed really small here. And I remember learning about the national debt, Brian, in middle school, right? So that would have been right in like this area here, right? and like that was like, oh my gosh, that's such a huge problem. It seemed like back then, but here we are.
Well, it's kind of like global warming. The temperatures on Earth keep rising. It's why. What's going to happen? There's going to be flooding and craziness, and the world is coming to an end. And look, certainly that's a possibility. But I would say a higher possibility is the way we're spending right now is not a path that's sustainable.
Now,
I don't know
it
how we get
might
under control.
it might mean that we'll avoid the recession and get the soft landing right
Good.
now.
Good.
It might, but it's not a very efficient way to spend this money. But it might mean that we'll avoid this soft landing for now, and then it's not a 2025 problem. It's a 2028, 2030 problem maybe, but it is a little dicey. I also think this will be inflationary, Brian. And let's take a look at the Fed. Fed's really pleased with this. Is the core CPI ex food and energy. It's really pleased that we're trending really solidly lower here. Which undeniably it is trending solidly lower, but we are still well above. I mean, we're not getting back the price hikes we got, and I'm not sure this captures all those hikes that we really got, but we're still comfortably above the pre-COVID levels. So we are nowhere near like this area of inflation. I don't know with these cuts and that spending, it's going to happen. I'm hopeful that it does. I think if they can make it happen, that's amazing. But I'm thinking it might we might end up, unfortunately, with a situation that we saw here with a double dip of inflation.
Yeah, I love how Paul is pleased about this, right, Joe? I mean, he lost, man. I mean, he lost the game. He's talking about transitory and inflation exploded. And like I said earlier in the show, burritos are now $15 a burrito. You lost. I don't understand how he's around, but it is what it is. I guess we'll just accept it. And, inflation back around 2%, we'll get back in line and they'll start to worry more about unemployment. Whether it's true or not, I'm a trader, right? I got to be concerned about what's the market going to do, whether and how the Fed is going to do that. And I think we laid out the right playbook for it. So we'll see where it goes from here, but maybe it's the right move, the wrong move, whatever. We got to find where there is opportunities to make money. And right now, the way interest rates are trending, what they're going to do with rate cuts, with the yield curve steepening back out, all that lines up for a long volatility play in the market, in my opinion.
Yeah, long inflation, if you can express it, maybe in gold, but I don't see this happening. And not to get too political, though, I'm kind of a cynic. I don't think that this problem right here, I don't think it's going away no matter who wins the election.
No, I don't think so either.
So this is just our system right now, and it's just spend because that's the easiest solution to all of our problems is to throw money at it.
Yeah,
it's the American way.
It's becoming that way. So what do we got? You got any more charts? Or are we going to get to the
Let's
trade?
Get to the trade of the day.
Well, by the way, before you do that, though, I just want to say we are just literally days away from launching our offering on being able to trade with us, get trade alerts sent directly to your email on how we play this. So if you happen to miss the show, you still can be aware of it. Plus, we update these trades going forward, and lots of cool offerings that we'll have here in the future, along with some other plays on a monthly subscription that Equity Armor Investments will be offering. And so go check out equityarmorinvestments.com in the coming days as we sort of revamp our website. We're still going to be investment advisors, Joe. I'm not firing you as portfolio manager. So we'll still manage our mutual fund. But it's something to go check out. So having said that, Joe, give me the trade of the week.
Trade of the week is coming up right now. Real quick before I do, there are 58 people here I can see watching live. Anybody who likes what you see, don't forget, like, subscribe, all that fun stuff. If you want to learn more about options trading, we happen to have a fantastic book which will help you do so. You can message me right now, right here. You can email me through our website. You can click on the link through our website to get it. So thanks again for everybody. And let's get to the big trade of the week. Now, this is Intel, what it's done over the past couple of years, 2.5 years. It's not pretty. They've had some disastrous earnings reports. They were being managed very, very poorly. But if you look at it on a little bit short of a time frame, I'm hopeful that this looks like some consolidation. Really would love to see, this area here taken out, decisively, with the bulls in control. Maybe this area acts as some resistance, 2450-ish. But I kind of think that if we can get above that level, stay above that level, I'm hopeful that for me and my trade, I'm hopeful that it can continue higher. Got a couple things working with this. So we do have the potential buyout or friendly acquisition, as Oracle calls it. And we also have like another investor coming in saying, hey, we want a piece of this too. So I'm kind of thinking there is kind of a floor here for this price.
Yeah.
So I think maybe the buyout isn't there, but there's more than one person looking to buy it. So I have that assumption. And then I also think, hey, there's upside potential. Maybe a third, fourth, fifth person, or just the market will get ahead of it and say, hey, looking down the line, Intel has huge investments coming in from the government. If they can figure out their chip making foundry to go with their chip design business and sales, if they can figure that all out, this could catch up and finally take some of that market share back from NVIDIA and AMD. A long way to go. They're way behind the game. But anyways, my trade is to take advantage of that, looking out into next year, looking into March again. I am looking to sell that 20 put. I think there could be a floor in the stock. I want to capture some upside exposure. If there is some more to be gained, I'm going to buy that 25-30 call spread. I don't really think it's going much past 30 before March. If it does, that'd be fantastic for me on this trade. And all, I get to collect money to do this trade. I think that's a no-brainer for me. I think it'll stay above 20 for sure. If it does go below 20, yes, I will be out and I'll be forced to buy the stock. And I think I'm comfortable doing so given all the other people looking to buy Intel at these prices.
Yeah, and remember, if I was doing this, I would also want to keep these are, that put is a cash covered put. So it means I would keep cash set aside in case I have to buy the stock at 20. But what do I do there? I put that in a money market fund. I put it in T-bills, something to earn me interest above that 5% mark right now, even though that might go lower in the coming months, so that I can recoup the fact that I need the stock to get above $25 to start making money. From 25 to 30. I would make $5 on this trade with it being capped out at $30, but I need the stock to go from 22.5 to get above 25 to start making more than the 50 cents that Joe would be collecting here to make this trade. So I will take that cash covered put, that cash that I have to cover the cost of the put, and or being put to the stock down there and earn some interest.
So I got maybe a 2 quarters worth of interest, which for the time being still earns something. We'll see. Maybe by March it'll be the Fed will cut to zero, but
well, I mean, look at it. It's what, $1.10 or so for an entire year worth of the stock. So you got 2 quarters worth. It's about 55 cents or so. Now your trade, you're collecting 50 cents. You're actually collecting $1. So
yeah, I think that's a decent do. I think it's the 20 is kind of the lower end of the range. Could it slip below there? I'm sure it could. To look at the long-term chart, it looks disastrous. I'm just hopeful that there are more buyers out there beyond those two. It makes sense that there would be. Makes sense at these levels that given the future that we're looking at, in which like everybody needs these chips, given the fact that they're being gifted $16 billion by the U.S. government. Oh, by the way, part of that deficit spending that we had brought up, they're just gifting that money to Intel. I think it makes sense to think about them here at these levels.
Yeah. No, it's been this has been a great show. I love the Intel trade. Like I said earlier in the show, full disclosure, we added that to client portfolios this week. And we laid out a lot on the volatility front. We gave you the playbook last week on the Fed funds and what they would do, or the Federal Reserve, when they would cut rates. And we were right. I think we'll be right here about volatility rising in the near future. And it's been a great show. Make sure you tune in every Monday at 1 p.m. Eastern. Watch the Trading Zone, sponsored by the MIAX. I'm Brian Stutland, portfolio manager at Equity Armor Investments, and a lot more to come. Follow me on Twitter at Brian Stutland. Joe, you got a shameless plug?
I've given all my shameless plugs, but I'm Joe Teague at Joe Teague on Twitter. Just check us out every week. Thanks everybody for tuning in. If you're watching us after the fact, make sure you like it. We got a potential request for our ebook, just like that. AK, yes, you can have our ebook. I will contact you after the show if anybody else is interested in it. You can reach out to me on Twitter. You can reach out to me right here in the comments here, and it is also available on our website. Make sure to check it out. It's a really good book about our days in the trading days, our mindset as traders, some really great examples of trades that went big trades in our careers, which are just really helpful to understanding trading options.
All right, guys, tune in every week, 1 p.m. Eastern. We'll see you next Monday.
Have a good one.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.